Good morning, everyone, and welcome to the latest episode in Retirement Plan Academy. My name is Zach Hurst. I'm with the Trust Company of Tennessee. And as a reminder to those who are with us for the first time, we are a financial planning firm covering both wealth management as well as retirement plan services across the state of Tennessee. So welcome back to many of you. On screen with me that I'll introduce in just a minute are Adam Davies and Miranda Carr. Adam and Miranda, it's pretty ironic, I think, that today's topic follows the one we did in January, and January's topic, for those who weren't with us, was around the potential changes in the retirement plan space with the Biden administration and what's being discussed there. This topic today, the investment selection and monitoring process, is probably the most important part of the entire retirement plan space and will never change. So it's completely different, but we're excited about this. And with that, let me try to pull up my screen and introduce the two of you with your power stances here. Although, Adam, I must say, Miranda looks a lot tougher than you do, looking at the photos.
That's because she is.
Exactly. Miranda Carr is our Chief Investment Officer at the Trust Company of Tennessee. She is really, if I can put it, I guess the way this presentation is laid out, she selects and monitors investments across both our wealth management platform as well as our retirement plan space. Adam Davies heads up our retirement plan space out of our Knoxville office. Both Adam and Miranda are chartered financial analysts and are perfect to present on this topic. Again, my name is Zach Hurst. I am a certified financial planner in our Chattanooga office and work with a lot of 401k and retirement plans in the space. So before we launch in, guys, I think we will just cover a couple of housekeeping items. Number one, we still got some people rolling in right now, but if you look in the box within this program, you'll see a little box in there that says chat. So post any question that you have into that. We'll try to cover it as they come in. If we don't get to it then we'll certainly leave time at the end for those. Number two is we are offering CE credit through this. That's going to be through both SHRM as well as HRCI. So in the next few days, you'll receive the codes for both of those from somebody on our team. So just be on the lookout for those. So as we get ready to launch in, we're going to start with a poll question and we're going to do this probably 3 times, I believe, throughout this and get some engagement from you all and some responses from you all. So we'll bring that up. The first poll question is going to be, as this opens, I would rather, and my screen's small, so I'm going to have to read off of my sheet here, but I would rather be solely responsible for selecting and monitoring investments for my company's retirement plan. Number 2, sing my favorite song in front of all of my coworkers. Or 3, or C, I guess as it reads, speak for 30 minutes at a conference on a key topic in your industry without any prep time. Miranda, is yours sing my favorite song in front of all my coworkers?
Yes, of course.
Some tough choices here.
They are. We left out D, none of the above. That was my fault. So we'll give just a minute and get the answers in. And C, which of these 3 not very fun things you would rather do. Looks like the results are coming, and oh wow, sing my favorite song in front of all my coworkers. That's the last thing I would do. I'd probably speak for 30 minutes at an industry conference with no prep time. So what we're going to do as we get started is we're going to start and to close this this program, if you will, with 2 case studies. Adam is responsible for introducing the doom and gloom part with the first one and talking about what can happen if we plan providers, you plan sponsors, don't set and follow a good process and introduce a case there. At the back end of this, I'll introduce one where those steps were followed and show the results of that. So Adam, if you are ready, I am going to let you launch into the first case study.
Sure. So Prime Healthcare Services is a large hospital system in the state of California, and last August they were sued for the investments in their retirement plan. Now, what I find interesting about this case is the investments that they were sued for didn't suffer large investment losses. They actually provided pretty decent returns over the period they were in the plan, but the participants pointed out they didn't perform as well as other comparable options. So specifically, they had the Fidelity actively managed target date funds, and the participants pointed out that the Fidelity index-based target date funds had actually performed better over long periods of time and at a much lower fee. So essentially, the plan participants were claiming that the plan sponsors, the company, did not appropriately select and monitor the investment options in the plan because there were better options with much lower fees. So this lawsuit was just filed in August. The outcome is still pending, but as we go through, we'll kind of give some insight as to how we think the case might go.
Excellent. We'll probably cover more of that in just a minute. I do want to point out one thing. I think when I said you could input questions here, I don't see a questions box here. I think on your screen there is a questions box. So I believe I said use chat, but if you do have questions, please use the questions box on your screen. All right, Adam. So I think the best way we can start with this, and some of this, if somebody's been on with us in the past, you've seen a little bit of this before, but it is important for us as plan providers on this call to understand what is our obligation and how do we partner with these plan providers and who is sort of taking responsibility for what. So Adam, do you want to talk to us a little bit about the different levels of fiduciary protection?
Sure. So, by default, the plan sponsor is responsible for selecting and monitoring investment options because by offering a 401k plan, a retirement plan, 403b, et cetera, you're essentially volunteering to be stewards of other people's money. And with that comes a certain fiduciary responsibility. That is outlined in the Employee Retirement Income Security Act of 1974, commonly known as ERISA. And what's interesting about ERISA is that it actually states that plan sponsors shouldn't just give their best attempt at managing the investments in the plan. They actually need to manage them as a prudent expert would. And so if you think about it, that's a pretty high standard because not everyone is an expert in investment research, looking at all of the different factors that make up these funds. But fortunately, the Department of Labor says that we realize you're not experts, and so you have the ability to hire a service provider who is, or delegate the investment decision making to someone who is. And so this is what you see at the bottom here, this 321 versus 338. This can take a couple different forms. So if you decide to hire what's called a 321 investment advisor, they will sign on as a co-fiduciary with you for the investments in the plan. They'll help you select them, they'll help you monitor them, they'll give you investments, and when changes are necessary, they'll give you recommendations on some potential options. So they might say, there's an issue with Fund A, here's Fund B and Fund C, the pros and the cons, which one do you want to choose? So ultimately, it's your committee or your company making that final decision. Another option is what's called a 338 investment manager. And here you actually delegate all of the investment decision making, and with that, all of the liability for those investment decisions. So, the 338 investment manager will never say, here's Fund A and Fund B, pros and cons, which do you like? They'll be proactively researching the funds on your behalf and then making changes when appropriate. And then finally, we see a third option pretty commonly, which does not carry any fiduciary status or alleviate any of that fiduciary liability. It'll be a financial professional that you hire. They'll act a lot like a 321. They'll give you recommendations, give you data to support your decisions, but they just don't agree to sign on to be a co-fiduciary. So if you're in doubt, just ask your provider, are you serving as a 321? Are you serving as a 338? Are you agreeing to take on any fiduciary responsibility? And they can help you answer that question.
Adam, I'll put you on the spot with this question. I'm curious about it myself, but what are some common reasons that you might see where a company might prefer a 321 over a 338 to make their own investment decisions?
Sure, that's a great question. And typically, if a committee doesn't have that expertise in managing investments, doesn't have a committee where people have a background in that sort of area, they might prefer to work with a 338 because they're able to completely delegate all of that investment decision-making process to an expert. So they're able to offload some of that fiduciary responsibility. Conversely, sometimes a 321 is preferred when you do have some of that experience in your company, on your committee, and you want to retain the control of the investment decision process. So there's no right or wrong answer. It's just how much of the decision-making process do you want to give up, and how much of the liability do you want to give up or retain?
Makes sense. Thanks. And I'll piggyback on this with this slide that you see here, and it's basically the different responsibilities that make up your role as a plan sponsor and our role as a plan provider within a retirement plan. And I believe that the way we've laid this out, the blue shade that you see here represents the areas that you can sort of hand off in terms of the responsibility to your providers. And the shades of blue here, I believe, suggest that this would be a 338 fiduciary provider. So you see going around, you see compliance monitoring, advice to your employees, custodying the assets, record keeping and administration of the plan. And then, of course, as we're talking about today, the investment selection and management. That one can be put off to the 338 or the 321 that Adam just mentioned. The two that aren't highlighted in blue, I'll start with the one on the bottom, and it says payroll, termination, census, right? So hirings, firings, things of that nature, census information on your employees, that has to be provided by you, and that's pretty obvious. The second one's really broad, select and monitor plan providers. So it's not as though you can bring in a 338 or a 321 and hand this off and that's theirs, right? And it's off your plate. It's still your responsibility to monitor those providers, be sure that they are in line with your investment policy statement or doing what's right for your employees. So just a nice little visual to show, I think, capture really what Adam just described. And with that, Adam and Miranda, if nothing else to add, I think I want to roll out one more poll question before we jump into what Miranda is going to start covering, which is the actual process. And again, I'm going to use my cheat sheet. Be sure this matches up, but passive investment management means, and we have 4 choices here, picking an investment and not reviewing it for 12 months. Number 2 is letting someone else act as a fiduciary for your plan. Number 3 is paying a low cost to replicate an index's return. Or D, I'm not sure, which we probably should have introduced that D on the first question. So we'll give it just a minute here, let some answers come in. Adam and Miranda, I would ask you what the right answer is, but I'm afraid you may know it.
I think Miranda would know it better than me.
Hopefully we know it.
That's right. Hopefully neither of you are checking the I'm not sure box. In just a few more seconds, we'll let the answers come in. And there we have it. So the most popular answer is letting someone else act as fiduciary for your plan. The answer is actually, looks like it's one of the lower ones. Paying a low cost to replicate an index's return is the correct answer there. I really hope I'm right on that, Adam and Miranda.
Yes.
Yes, that is a passive versus an active investment decision. And so with that, I think that's a great launching point to Miranda to get you started here and walking us through what does active versus passive mean and why does it matter?
Yep. So I think this is the really high level decision that gets made first when we're thinking about what selection we're going to make in our investments. And so passive sometimes has a negative connotation as a word. Here it's not negative. It simply means replicating an index. So the news reports performance from the Dow Jones or the S&P 500, but investors can't directly invest in those indices. They have to go out and find a fund that replicates the performance. And so that's called a passive fund. It's just seeking to track the index and have performance that's pretty similar. Active managers, they're not seeking just to replicate, they're seeking to outperform. And so with the S&P 500, a passive fund would just go out and buy the S&P 500 stocks. An active manager would say, I want US large cap stocks, but I think I can do better than the S&P 500. And so I'm going to, buy some of those and avoid some of those. And it does matter because different asset classes do better whether they're passively managed or actively managed. And so there are 2 criteria that we want to look at here. One of them is how easy is it to replicate the index? So back to my S&P 500 example, it's pretty easy. We know the 500 stocks that are in the index. They don't change that often. It's announced when they're changed. The methodology is publicly available. They're all big companies that we can easily purchase, easy to replicate. Something that's more difficult is high yield bonds. So the high yield bond index reports a composite of the performance of these high yield bonds, but it's not very easy to buy all of the high yield bonds in the index. So they might be illiquid, the trading costs are higher, and so there's not a low cost way to replicate that. So that would be in the harder index performance replication box. The second thing is, okay, so you can replicate the index, but can you beat it? And so that's what we mean by alpha opportunity. Is there opportunity to persistently outperform the index? And so you can see large cap US stocks, again, the S&P 500, lower alpha opportunity, much more difficult to consistently outperform this index than some of the other asset classes. So if we look at emerging markets indices tend to have variety of countries, lots of different regions and sectors. And so there's a lot of opportunity for active managers to make bets and avoid certain segments that are in the index and lean into certain. So higher opportunity to outperform, and also a little bit more difficult to replicate that. So some people are really proactive or really pro-passive, and we tend to take a blended approach based on the research that it makes sense in each of these categories depending on the asset class.
Yeah, that's interesting. So as we go through our participant enrollment meetings and sit down with a participant who's coming into the plan or just selecting investments, really, Miranda, one of the biggest questions we get are fees, and so there's a lot of explaining this, right? So yes, you can go out and find the best fees associated, but you're also going to lose performance in some of these sectors. But as you lay this out for our company, right, and as we deal with our clients, it looks like, I'll just pick one of these, the large cap US stocks. Clearly, we favor the passive much more than active on that. So knowing that, do you set a lineup saying we're so confident in this, we're only going with passive investment options, or do you also include active options?
In this case, we would just go with passive because it is easy to replicate. It's very difficult to outperform consistently, and there's a low fee associated with that. So if you wanted to find an active manager, again, you have to pay expensive investment professionals to do that work. And after all of those costs are adjusted, it's even more difficult to find one that outperforms. So we would really lean into passive in that asset class.
Got it. And I know that there's a huge range on this, but I do want to try to put numbers to this. If you're talking about an index or a passive investment, again, in the US large cap space, you're talking about maybe what, Miranda, 0.03 to 0.07% as a general range. Does that sound about right?
For fees?
That's right, for fees, yeah.
Yeah, they tend to be really low cost because you're not having to pay those professionals to do it, and it's easy. They're low trading costs. It's easy to do, so really low fees.
Okay, yeah. And then active, I know there's a huge range on active, but you're talking about 10 times more sometimes, right?
Yeah, so it depends. An active large cap fund, the fee on that would be lower than, for example, emerging markets, right? So it's much more expensive to have investment professionals sitting in emerging markets doing the work, and sometimes this reflects trading costs too. So if the trading costs or the market is illiquid, then the fee might be a little bit higher. So it's important to look at the performance and net of fees. So looking at, can they outperform including the fee, right? So after they've paid themselves and after they've taken the fee, do they still outperform the index? And so that's important to keep in mind because a lot of these active managers can, and that's what you want to find is after they've paid themselves and taken their fee, can they outperform? And yes, the answer is often yes.
Yeah, got it. Okay, great. I will let you move to our next one, and this is really getting more in depth in terms of the actual investment selection, right? And how we actually choose that. Is that right?
Right. So once you've decided in certain categories that you want to find an active manager, how do you choose which one? I mean, there are so many options. And so this is where the bulk of the work comes in. This is the fun part. So initially you have to screen down thousands and thousands of choices based on some quantitative screens to get to a more manageable set to actually dig into. So once that's done, we take a 4-pillar approach, and it's not just looking at performance. In fact, that's not the right approach, we would argue. We look at first the organization as a whole. Is the company stable? What resources are available at the company level? Are they reputable? Have they been in business for a long time? So is the organization a sound, going concern business? Then drill down to the team. Who's on the team? Do they have a diverse set of experience? How are decisions made? How long have they been interacting together? And what does each person on the team bring to the table? So that's really important too. What I would argue is the most important is looking at their investment process. And so how do they decide which securities make it into the portfolio? What criteria do they use? Is it repeatable? Is it disciplined? Are they following a set process every time and we know what it is, so we know what to expect? We know how to evaluate them in different environments, and making sure that they have thought about this and they're thinking about it when they add new securities to their portfolio. And then the last piece is the portfolio itself, the construction of the portfolio. So they got a good company, a good team, a good process, but how do they decide which securities make it in and which are sold, right? So they have buy-sell criteria. Do they think about how different securities interact within the portfolio? And then looking at different risk metrics and return metrics within the portfolio as well. So all four of those are really important. You can't just do just one of those. So the quantitative piece with return and risk, important but not sufficient. Also looking at these qualitative pieces about who is the team and what's their process, I would argue is equally important.
So I'm sure there were some people shaking their heads a little bit because in the initial part of that, I believe you said that you would argue that performance, while it's factored in, right, at some point across this process, it's not one of the main four here. Keep that in mind. We've got a, to the audience here, we've got a case study we're going to close with where that might make no sense at all, but you'll see in real life how Miranda is exactly right. And this is the process we need to understand as you as plan sponsors. And I'll illustrate that a little bit more shortly. Adam, anything to add here?
No, I think Miranda did great.
Cool. So Adam, we will kick it over to you for a minute and just talk about what this all means as it relates to retirement plans.
Sure. So as you consider what investment options to offer in a retirement plan, it is a very different process than what you might consider for a wealth management account or an endowment or a foundation. Essentially, what you're trying to do is create an investment lineup. And so that lineup, you want it to be sufficiently diversified, have plenty of different options to choose from, but you don't want it to have so many options that it overwhelms the participants and they experience what we call paralysis of analysis. So there was a really great study done a couple years ago by the Wharton School of Business that really defined how much choice is too much choice. And so they found that once you get beyond 30 investment options, you can actually see plan participation suffer. So just last week, I was looking at a plan. They had 43 different investment options. And I wasn't surprised to find that the majority of the assets stayed in the plan's default investment option, which was the target date funds. So with 43 options, how do you look and evaluate across all of those? We're all busy. We may have other activities, children that we need to keep up with. You just don't have time to manage 43 different investment options. So what we typically see is kind of around that 20 or so investment option mark is the sweet spot. That gives you plenty of choice to pick exactly what you want, but not too much choice that it overwhelms participants. When you're looking at what 20 or 30 funds to offer, there's definitely some options that are appropriate for retirement plans, and there's definitely some that are not. So you want to stay away from illiquid areas of the market like private equity and hedge funds. Those are definitely better for endowments or foundations. Also, you want to stay away from funds that are highly volatile. Sometimes we see these in sector funds. That same plan I was looking at last week, they had an energy fund. And so if you think about it, all of that fund's holdings are concentrated in the energy sector and highly correlated to the price of oil. So as the price of oil goes up or down, the fund is going to go up and down in the same fashion. And so we see that is a lot more volatile, and that can cause problems because in retirement plans, they're participant directed. Participants have the option to go 100% in any option that you offer in the plan. So by offering something that can fluctuate, so dramatically, you have the option for participants' accounts to see wild swings, and that's just not something that is really ideal for retirement plans. Finally, we understand that all different participants, have different preferences, and so what we commonly see is that you offer different ways to invest. Probably the most common is target date funds, and they get their name because these funds are targeting a specific retirement date. So if you've seen investment options in your plan that have a year at the end of them, it might be 2030, 2040, 2050, 2060. These funds are being managed to automatically get more conservative as you approach that targeted retirement date. These are great options for a lot of people because they can set it and forget it. The fund will automatically get more conservative as they get closer to retirement. But that's definitely not appropriate for everyone. Some people really identify as aggressive or conservative or somewhere in the middle. And so that's where we see risk-based portfolios come into play, where participants can say, I'm aggressive, I want that growth portfolio. I'm conservative, I want something that's more of a fixed income portfolio or somewhere in between. And then finally, for people like Miranda and myself that really enjoy rolling up our sleeves, getting into the prospectuses, looking at the funds and researching them, there's typically individual funds. These often fall into three categories: equity funds, bond funds, and then capital preservation funds. So you'll typically offer a couple different stock funds. This could be US, international, value growth, large or small companies. You'll typically offer a couple of bond funds. It could be core US bonds, government bonds, international bonds. And then finally, you'll have capital preservation options like a money market or a stable value.
And earlier you mentioned a default investment option. I believe you tied that in with the target date fund. Does every plan have a default investment option for participants who just say, I don't know what to do, put me in whatever?
So not every plan has one, but if your plan doesn't, it should, because that does allow for extra protection for the employer. And so what we typically see is that it will be a target date fund, but it could also sometimes be like a balanced portfolio, a mix of 60% stocks, 40% bonds. But that's good protection for you as a plan sponsor to specify in your investment policy statement. We'll cover what that is in a minute. Exactly how participants will be invested if they don't make an affirmative election.
Okay, gotcha. And so if a plan does not have target date funds, but they do have a default investment option, is there one type of investment that you typically see as that default?
So most commonly, that would probably be that balanced fund.
Okay.
Prior to the Pension Protection Act of 2006, it was often a stable value fund.
Mm-hmm.
But what we found was that by defaulting participants into a stable value fund, their accounts really weren't growing the way that they needed to. So, a stable value fund is very conservative. It might earn 1 or 2%. So by defaulting participants there, you weren't helping them get on the path that they needed. And so that piece of legislation gave employer protection to default them into something more appropriate, a little bit more aggressive, but again, more appropriate for their long-term goals. And that's that balanced portfolio or those target date funds.
And this is probably unfair to ask you, but I'm going to do it anyway. But if there are plans and plan sponsors on this call who do still have stable value as a default investment option, is that kind of a red flag that needs to be reviewed, or is that okay still?
I would consider that to be a red flag because, again, if you have someone working for your organization for 30 or 40 years, earning 1 or 2% isn't going to help them get to the retirement place that they need to be. That could pose risk for your company, and that maybe they'll work much beyond the age of 65, and they might not be able to retire when they want. So I would definitely look at what is your qualified default investment alternative. That's the technical name for it, and consider choosing target date funds or at least a balanced portfolio if you're not doing that already.
Okay. There's a good action item and takeaway, so certainly look into what that default is. I think, let's not confuse this, having some sort of a stable value option within the plan is still a great thing to have, right? There are some people who just don't want that risk, and Adam or Miranda, correct me if I'm wrong. So we're not saying take that out of the plan altogether, just be sure it's not the default, correct?
Yeah, definitely. I mean, having a very stable capital preservation option like stable value is really great to have because you could have people that are approaching retirement and they want to set aside a certain portion of their account to make sure that it's secure. For most people, having 100% in stable value probably won't help them reach their long-term goals, but it can definitely play an appropriate part of a diversified portfolio.
Great. Thank you much. And Miranda, I think I'm going to kick it back over to you to talk about I guess now we've selected, and now we're going to talk about how to monitor these investments.
Yeah, so this is a really important step. So if you've found a great manager and you've got them in the lineup, you can't just keep them there until Kingdom Come. You actually have to babysit them a little bit. So once they're in the lineup, there are a number of changes that can take place, and there are a number of reasons that managers might be terminated or at least warrant a closer look. So if someone really important leaves, that's definitely something you need to look at, like a director of research or a portfolio manager or even a executive of the company. It definitely would cause us to see if this is going to have a material impact on the fund going forward. If there's persistent underperformance, that's not a reason in and of itself to terminate a fund, but it is a reason to take a closer look and ask why. Why are they underperforming? Is it the environment, or are they just not following their process? Has their fund gotten too big and they can't maneuver as well? If there are any changes to strategy, so if a manager changes their benchmark or changes their criteria or starts to look in a little bit of a different part of the world or a little bit different part of the risk stack, that's one thing to look at. Is this fund still going to play the role that we want it to in the lineup or in the portfolio? And then of course, organizational instability. If there's bad headlines or press around the company, or if an important executive leaves at the company, it's also worth taking a look. So this is not an exhaustive list of things that we monitor, but it's some big things to monitor that you really want to get in front of bad performance. So waiting until a fund is underperforming consistently over a long period of time to make a change is not preferable. You really want to look at those things and identify things that could lead to a period of underperformance going future and make a change ahead of that. So we have funds that we've terminated, and people will say, well, this fund has a really good track record and the history is good. Why are you changing it? And some things happen. Maybe the portfolio manager has left, or maybe they've changed their strategy. And so we're really trying to get in front of underperformance in the future by making a change now.
Yeah, and just to sort of relay what the process looks like on our side with our clients, because this is everything you just said is completely accurate, but it could be overwhelming too to a plan sponsor to say, well, I'm supposed to do what? and go through all of this. So this is what Miranda and our team are doing behind the scenes on our side, putting funds on a watch list for the reasons you just mentioned, making a change, right? So that's information that we're taking out to our clients saying, here's what's going on, here's what we're watching, just so you know where things stand, and so that we can document this as part of your process. Adam, one question for you on this though, and let's go back to what you said earlier about a 321, where the committee or the person or the company is ultimately making the decisions. Should they still rely upon their plan providers for this information, or is that something they need to monitor?
So they've hired that service provider to give them the tools that they need. So in the example of a 321, what would likely occur is that at your next plan review meeting, they would come to you with something like this flash memo that you see on the screen and say, the managing director of the fund is retiring. We think this is a minor issue and let's put the fund on a watch list, or we think this is a major issue and let's go straight to termination. It would look differently under a 338 in that they wouldn't come to you and say, here's what happens, what do we want to do? They would either replace the fund or keep it on an internal watch list, and then at the next meeting, keep you updated as to what decisions they've made. So they might say, hey, we've noticed this, we're going to watch it for a while, or they might say, hey, we've noticed that it was a big deal, and so we took care of it the week that it happened because it was a big enough deal to hurry up and make a change.
Okay. And you mentioned, meetings or regular meetings with the committee. So I'm going a little bit off topic here, but it's important to cover, I believe. So I guess the question is, for the plan sponsors on this call, how frequently should they require or request, require really their providers to come in and meet with them? And should it only happen when things like this occur, or what's sort of that lineup, Adam?
Definitely. So probably the most important thing is that you are meeting regularly with your providers, regardless of whether they're a 321 or a 338. We would say at a bare minimum, at least once a year. But if you are working with a 321 investment advisor, there is a need to meet a little bit more frequently, perhaps even quarterly, because again, they're giving you the tools you need to make your decision, but they need to be able to meet with you to give you those tools. Whereas a 338 investment manager is doing all of this behind the scenes and keeping you updated. So you still have a need to meet, but just not as frequently because they're doing a lot of it on your behalf.
Okay, got it. Good. So let's go with one more audience poll question. whenever that is ready to launch before we go back to Miranda to cover more about monitoring. And here we go. The question is, if one of my investment managers has poor annual performance once over a 3-year period, we should remove that manager. Is that true or is that false? I guess part of that could depend on how poor that annual performance was, but I guess we're speaking generally. And Miranda, I'm sure this is a question you get quite a bit as we go through periods of underperformance as well from time to time with some of these.
Is.
Not that we would ever have underperformance, of course. And here we go, results are coming in. False, that is correct. The overwhelming majority say false. There is a lot more that goes into this, as Miranda pointed out. And let's think back to what she said with the 4-pillar process of reviewing these managers and really performance, while it factors in not being one of those main 4. And so there's reasons why. Yeah. So Miranda, I'm sorry, go ahead, Miranda.
I was going to say, very astute crowd. Because the disappointing news is that managers do underperform. So, we spend all this time finding the best-in-class manager, and then they spend considerable amount of time in the bottom half of their peer set. So don't expect that your investments are going to be at the top every single year. That's just not going to happen. In fact, 83% of managers who over a 10-year period are in the top quartile have spent 3 years in the bottom half, and 54% of them have spent 5 of those 10 years in the bottom half. And so really what we're looking at is long-term performance. What's the goal of the manager in the portfolio, and why are they underperforming? So it's really important to understand how they're benchmarking themselves and how you view them, or how we view them. And so we can gauge, are they doing well relative to their benchmark? Are they doing well relative to their peers? Even if on an absolute basis it looks like they're not doing that great, it's important to have context. And so one example, for if you want Europe in your lineup, for example, Europe has been underperforming the US for a while, and so if you're just looking at a fund that's exposed to Europe, you might think, oh, this fund's not doing very well. But if you have a fund that's up 8%, and the peer set has been up 3% or something like that, then they're actually doing really well in their category, and so that's not a reason to terminate. Conversely, you have some managers who are posting really nice performance, but they might be underperforming their benchmark or their peer set again. So it's really important to ask why when you're looking at performance, and also just to know that even the best managers have this point that is underperforming over a longer period of time. 3 years is pretty painful to be at that bottom half, and really understanding why are they underperforming. And so one of the questions that I ask managers every time that we're looking at and doing due diligence on new managers is, in what environment would you expect to underperform your benchmark or to underperform your peer set? And they almost always have an answer. Managers should know what environments are favorable to their strategies and which are unfavorable to their strategies. And so if they tell me, well, if interest rates rise quickly and unexpectedly, our fund might underperform relative to the benchmark, then we can go back and look, if they are underperforming, is this a period when interest rates are rising quickly and unexpectedly, because that's really in line with their process. And so it's not a concern in and of itself. If you have a manager who is underperforming in an environment that should be favorable to them, I would say that's more along the lines of, let's really dig in and possibly terminate, because they're underperforming when they shouldn't be. But I think it's just important to understand that all managers underperform at some period, and what we were really looking for is a manager who can outperform over very long periods of time. So not focused on the short term, focused on the investment process, and then focused over long-term returns.
And one thing that I think will make a lot of people on this call happy is that the Department of Labor realizes this, and they don't expect you to have a crystal ball and to always have the #1 performing fund in your plan at all times. And so if you think back to that case study we showed at the beginning, the plan participants were suing because the Fidelity Index Target Date Fund had done better than the Fidelity Actively Managed Target Date Suite in the plan. just on that alone, the lawsuit probably doesn't have a lot of merit because, again, no one has a crystal ball and no one's able to see into the future to see which one will be the top performing. But the focus of the lawsuit will likely be the process by which they followed to select those investments. So if they had a disciplined process that, if followed, should lead to good results over long periods of time, there probably won't be much of a case. But they're going to be looking into what was the criteria and how you selected these funds, how did you document it, what alternatives did you look at, and that will probably be the determining factor on whether the lawsuit is successful or not.
And Miranda, do you mind saying, I mean, that was really fascinating what you said in the beginning of this. What were those percentages again of managers who had performed very well over the 10-year? What'd you say on that?
84% of them are in the bottom half for 3 years. So
Wow.
almost all of them are in the bottom half at some point in time. And then 54% of them are in the bottom half for 5 years. So half of the time they're not doing so well, which again, really painful. And it's really why it's important to ask the question about the process. And that's why I think the process is so important.
Yep. And so is that 10-year return, right? Because we talk about retirement plans and this is invested over a longer period of time. And so you look out more historically. So that's pretty interesting. Great. And we noted on that last slide what actually warrants a change. Adam, if you don't mind, I'm going to have you walk us through this and when would we make a manager change?
Sure. So, essentially everything we've been talking to up to this point is leading to this question. So ideally, you should have a process by which you're monitoring the funds, looking for changes, and once you found one, what do you do next? Well, it really depends on the severity of the item that you noticed. So it could be something like a member of the team is leaving. So what you'd want to ask yourself is, how important was that member of the team to delivering the investment results? If it was an analyst that just contributed to the decision-making process, that might be an area where a manager goes on a watch list, or it's something you monitor for a couple quarters, see how the fund responds. But if it's the lead portfolio manager, the person that was responsible for all of the success of the fund in the past, that's probably a more significant change, and it could lead directly to a manager termination. Another example, and I liked what Miranda said about understanding the environment of the fund. So you could have a very conservative fund and you would expect it to lag over long periods of time when the market outperforms. But then you'd want to see how that conservative fund performed in a down market. So looking at last year, when the market was down 34% during the coronavirus, did it lose less than 34%? So you want to understand the environment that it is in context with its performance to make sure that it's behaving as you'd expect. So really the severity of the change or the issue noted is what will determine whether you just monitor it for a few quarters or go directly to termination. And again, this is what your service provider should be helping you identify.
Good deal. And I know you have a few more things here to cover on that, so I'll let you walk through this one as well.
Yeah, so part of your fiduciary responsibility is making sure that the plan fees are reasonable for the services that you're receiving. And so the expense of the investment ties into that. So that's why we started with what areas should you use low cost passive index funds, and what areas is it appropriate to pay a slightly higher fee with the expectation that their performance can recoup that and then some. So what you want to look at is the net expense ratio of the funds, and this will be determined by their share class. So at the end of their name, you should see some letters. You might see A, C, institutional. Some others that we see are R6, K. It's really all over the board, but essentially there's some higher priced share classes. These are typically A and C. And typically some lower expense share classes, institutional or R6 are two of the more common ones. And so you'll want to evaluate the expense you're paying for the fund, and is that appropriate? So what your service provider can help you do, and we help clients with this all the time, is we'll benchmark the cost of the funds versus other comparable options to make sure that you're getting the best bang for your buck. And you can really identify this by asking for what's called a plan level fee disclosure. And this can either be called a 408B2 or a 404A5. So these are documents that your service provider should have handy. You can ask them at your next plan review, can you give me a copy of my 408B2 or 404A5? And that'll tell you exactly what the fees are. And then you can benchmark those to make sure they're appropriate.
Deal. And then, Adam, I believe we have one more for you here, talking about the investment policy statement that you mentioned earlier in review meetings. This is probably, as we think about, and quite frankly, I'll be honest, this is not a scare thing at all, but we think back to March and April of last year and really over the last 3 years. I don't know if it's participants paying closer attention to what's happening in the plan, but we've seen so many more filings and suits coming about, and really any action from those suits seems, Adam, to boil back down to these two things, right?
Definitely. So in the event of a lawsuit, what's going to happen is they're going to ask for a copy of your investment policy statement, to be abbreviated your IPS. And so essentially this is the blueprint by which you're designing your investment process. So it'll have in your IPS things like, what is your process for reviewing the investments? When do you consider a manager termination? What is the default investment option of the plan? And so if you lay down your investment process and follow it consistently, that's going to give you a very strong protection in the event of a lawsuit like this. The other thing that's going to be really helpful is your meeting minutes, documenting those, because that's going to identify when you've monitored these investments, that you've followed the process that you've outlined. And so if you think back to that original lawsuit, if they had in their investment policy statement, this is how we're selecting the funds, this is how we're monitoring them, this is when we're going to make a change if needed, and then they had documentation in their meeting minutes showing that they looked at the performance of the fund, they looked at other alternatives, they understood exactly why it was behaving the way that they did, I would think that the lawsuit would eventually be dismissed because they have followed that consistent process as part of their plan reviews.
So the IPS, the investment policy statement, I'm sorry if you said this already, but Adam, who creates that? Is it the plan sponsor or the committee, or is it the provider of their plan?
So it could be either. It really just depends on what type of service provider you're working with. If you're working with a 338 provider, they're typically more likely to create the investment policy statement because you're delegating all investment authority and liability to them. So they're more likely to specifically outline, here's the exact process that they're following, and because it helps protect them. If you're working with the 321, again, they are just giving you recommendations, analysis, and so it might be the plan sponsor that creates the investment policy statement because ultimately they're the ones making the investment decisions. So it really just depends on what type of service provider you're working with.
Okay, and I'm sure it's probably too common, that to where some people maybe don't have one at all, right? So it is important, another sort of takeaway from this, to create that and get the process going there.
Definitely.
So we promised you a good news case study, and this is American Century Services. This is an investment firm, and they were sued by participants within their plan. The plaintiffs or their employees had argued in this case that, and this goes back to what Miranda had said too, that they focused too much on performance, right? So the participants said, we're using all of our own funds, right? So all American Century funds, and we're looking at performance of these funds versus their category, and they've underperformed for 2, 3, 4, 5 years, against what we're seeing out here. Clearly, they should be shopping around. They're just trying to take advantage of more money coming into the company by using only their funds. That was sort of the background. The plaintiffs, or American Century, actually won in this case, and I believe it was maybe appealed at 1.2 and was very quickly upheld. But I'm going to just read some of this off because it's pretty important. The courts did find that the plaintiffs focused too much or too heavily on the actual cost comparison and the performance comparison of this, when the courts were really looking at the process itself. And what they found in the process, the committee within American Century, number one, they had a committee, right? That was important to the courts. Number two, the committee was trained as to what its fiduciary obligation is as being a part of the committee, and understand what the investment selection and monitoring process is, and what their investment policy statement is, okay? And then most notably, they relied on that IPS, or investment policy statement, to determine at what point should a fund be added to a watch list or terminated, things that Miranda and Adam have already covered today. And the fourth thing they highlighted, that the courts highlighted, is that the IPS did not set strict parameters. So it gave the committee a lot of flexibility to sort of look back and look at the four pillars perhaps that Miranda had described earlier, and not just react to, okay, we've seen a 2-year underperformance from this fund, it's time to go. So it was written more broad in nature, and it gave them that ability to say, here's what's actually important to us, and here are the things that we monitor, and they actually monitored those things. So it was pretty interesting. I mean, really, it was about a process, following the entire process. And the last part they said is the court also noted that the committee meetings were consistent and thorough, and the court was able to read through detailed minutes from each one. So Miranda, Adam, I think the word to take away from all this is, what's the process? And as long as you're following that process, right? Miranda, you and Adam and I probably could disagree. We could have an argument about who was right and who was wrong in this American Century case, right? Maybe they were using too many. I would argue that. Miranda might say, well, no, not necessarily because of this, this, and this. So we may not even agree on this, but it doesn't matter. It was a process that they followed, and they ended up winning. Anything to add there?
Definitely, and I just circle back to the fact that, the Department of Labor recognizes that no one does have that crystal ball. So all you can do is put your best effort forward, have that consistent process that if it's followed rigorously, it should lead to good outcomes, and that's exactly what we saw in this case.
Yep. So we had a couple questions come in before I go to this final slide, and let me just read through these. This must have come in as I was talking about this. The question is, all of my funds are offered by the same company. Is that a bad thing? Miranda, maybe you could take that one. I would guess based on what we just said, not necessarily, but do you want to elaborate on that?
I would say not necessarily. I think it goes back to process. I think it is important to understand if there are conflicts of interest, if a company is offering proprietary funds or if they're not, and what their process is for looking outside of those. Adam, do you have additional thoughts on that?
Yeah, so I mean, sometimes we see this pretty commonly in the retirement space. You might work with Fidelity or Principal, or your lineup will be all Fidelity funds or all Principal funds or all another company's funds. And so my opinion would be that there's probably areas where Fidelity does an exceptional job, probably areas where Principal does an exceptional job, but they're probably not the best in every single area of the market. And so that's something that we really look at when we're doing our 4-pillar process is who is the best manager in large cap growth? Who's the best manager in small cap value? Who's the best manager for fixed income? And we're really trying to find the best of breed manager to have the top conviction idea for every asset class. So our opinion would be, find the best manager, not the best fund company.
Got it. And Adam, I guess this question came in, and I know we've brought it up on previous webinars as well, but we've used this word a lot, and I guess that's why it came in. But the question is, what if I don't have a committee? This coming from a plan sponsor, I assume.
Yeah, so that's a great question. Committees are not required, but they definitely provide you with additional protection in the case of a lawsuit like this. So having that organizational structure in place where you have those regular committee meetings, you have diversity and representation from different areas of your company, just shows that you've put that much extra thought and process around the investment monitoring and selection process.
Good, and that is, I believe, all we have in questions right now. So let's look at the next topic coming up. This is going to be on March 25th, again at 10 o'clock. This is increasing employee participation within plans. That is another very frequent topic we deal with our clients and trying to find ways to boost that. So it'll be interesting. Adam, you may have to help me with this. I was lectured by our marketing director, Lindsay, who's behind the scenes today. I believe I know one thing that's going to change this time. We do have the ability to have a hybrid with this. So there's going to be an option for in-person for this one, as well as we'll continue to do a webinar. Adam, does that sound right based on what we heard earlier?
Yes, so we all enjoy these webinars, but we also enjoy in-person meetings as well. So we have a large conference room at our Knoxville headquarters, and we're going to offer in-person availability for those who want it. Socially distanced, of course, but you'll have the option for the next webinar to attend either in person at our headquarters or still virtually through this webinar format.
Perfect. Adam, Miranda, thank you so much. Miranda, thanks for joining us for this one. I think it was nice to have your expertise on this. It's a topic that can be a little bit overwhelming, but I think the two of you really broke this down into what the roles are and what to look for, and again, what processes to establish. So with that, we will wrap up a few minutes early and wish you all a great day. And if it's anything like Chattanooga, it's going to be about 65 and sunny, so get out there and enjoy it. Thank you all.